Coming up in today's show, S&P 500 hits new records led by tech, US business activity accelerates, a look at the market's reaction to Tesla earnings, China unveils new stimulus measures for its economy, sending their stocks higher again, oil pops up on supply drop, and she did it again. Nancy Pelosi front runs a new partnership between the US government and Nvidia. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. Hope you're all doing well out there. Another interesting day on Wall Street. S&P 500 actually broke out to new all-time highs, and that was thanks once again to the Magnificent Seven led by semiconductors. Also had a huge pop-up in Netflix today after earnings yesterday, with financials doing well and along with energy, oil and gas on the back of a higher crude price. The rest of the market was quite a bit weak, especially the yield-sensitive sectors of REITs and utilities. And we just got earnings from Tesla, actually coming in a little bit lower than expected. This is how the market's trading after hours as I speak, currently down 2.6%, just holding above $200 a share. And looks like we've broken down through the support zone we've been watching from that gap up in early November. There's a look at Nvidia today, actually getting up to $6.28 a share, and a big rip in Netflix on the back of their earnings. However, stick with me because I'll dive back into the charts later on and show you guys everything else that I'm seeing out there. And before we get into the daily show, I just want to say a quick and huge thank you to all my loyal subscribers that tune in every day. The Click Capital channel's now just past 5,000 subscribers, and I started it a year ago in order to share my insights and technical analysis of the charts. And so it's grown a lot better than I imagined, and I know this is still a tiny channel in YouTube terms. However, I'm really happy with it so far, so thank you very much for everyone who tunes in every day. I really do appreciate it. And for those of you new to the channel, let me just give a quick introduction about who I am. My name's Jared. I previously worked for Australia's largest investment bank until 2008. Before I resigned, I own two finance companies, one for Click Capital, another one for my trading. I'm designated by my government broker in the exchanges as a professional investor, qualifications and financial services. Been trading for over 20 years, working for myself 16 years. I live in the beautiful Queenstown, New Zealand, enjoy everything about the outdoors, and I'm focused on growing my business Click Capital. Okay, enough about me, let's dive into the daily show. We've got the S&P 500 actually getting above 4,900 today for the first time ever. And there's a look at the 5-minute chart. We gapped up today, peaked out a bit above 4,900 and finished a bit soft, closing that gap. There's a look at the NASDAQ Qs, also breaking out to new all-time highs. That's thanks to the Magnificent Seven, which as a group, they're up over 1% today. However, we did see a bit of weakness in breadth. That's why we got the Russell 2000 down 0.82%. We got some economic data today confirming the US economy is still holding up really well. That's US business activity measured by PMIs, showing the first half of January picked up at the sharpest pace since June last year, along with inflationary pressures also easing. And there's a look at the expectations and the actual numbers today. On the PMIs, services beating, same with the composite, and manufacturing, even managing to get back into expansion territory above 50. So it's no real surprise we've got Treasury yields trading up again as they price in a stronger economy. And we've now got Fed fund futures given an almost 60% chance the Fed's going to stay on hold in March. Been a big change over the last couple of weeks. Still forecasting they're going to cut in May. However, if we keep seeing hot economic data, especially if we were to see a surprise uptick in CPI, the market's going to keep pushing out when the Fed's going to start these rate cuts. And there's a look at the government bond 10-year yield. Looking to have broke this downtrend here. We seem to be holding and going into a bit of a short-term uptrend and what's been a bit of a clear repricing over the last couple of weeks. However, stocks are not really seeming to mind the increase in yields, and crude oil starting to pop up as well, now getting back above $75 a barrel, as we got a bit of an unexpected drop in crude supplies. Not to mention some big stimulus measures coming out of the world's second largest consumer of oil, China, of which I'll get into a bit later. And so if we see a bit of a reversal in the oversupply, continued strong demand from the US, a pickup in Chinese demand, ongoing conflicts in the Middle East, then oil could continue its path higher and could drag inflation with it. However, the stock market bulls aren't really fazed by all that. That's Fundstrat's Tom Lee, who did correctly call last year's performance. Says there's 5 reasons the stock market rally will broaden out to more names this year. The first being the Fed's policy posture, saying they're going more dovish. That's good for the market. It's pointed to the pullback in the 10-year Treasury yield over the last couple of months. Also mentioned the housing market is loosening with more inventory and tumbling mortgage rates. Also said the outlook for CapEx, which is the money companies are spending on their business, is improving. And finally, and this is a big one, he said the reversing stock outflows between October 22 and December 23, in which investors pulled out a cumulative total of $240 billion. Lee reckons a huge $5.5 trillion in money market funds will make its way back into equities as the Fed signals rate cuts. And if he's right, that is a huge amount of firepower, which could send the indices rocking higher this year. However, one important stock which is not enjoying the rally so far this year is the smallest stock of the Magnificent Seven, and that is Tesla, who is no longer in the $1 trillion club. It's now trying to hold above 650 billion market cap, and they just missed on their Q4 earnings expectations. With analysts expecting them to report 73 cents in earnings per share, they actually came in at 71 cents, with them saying in 24, our vehicle volume growth rate may be notably lower than the growth rate achieved last year, as our teams work on the launch of next generation vehicles at Gigafactory Texas. They went on to say the company is between two major growth waves. They did see an increase in sales to 25 billion from the quarter, from 24.3 billion a year ago. And so Tesla doesn't just sell EVs, they also operate its own network of charging stations. They sell solar roofs to residential consumers, battery storage products to utilities. And so those non-automotive sales in the fourth quarter hit 3.6 billion. That was up 4% from a year ago. So non-EV sales are still around 15% of their overall sales. And this is really kind of what the market hangs its hat onto with its lofty valuation, is kind of pricing in those future products outside of EVs. However, with them cutting prices around the world, that's squeezing their margins, which is their number one source of funding for their non-EV projects. And so part of that big rally we had out of late 2019 into Q4 21 wasn't just COVID stock mania, it was also the increasing profit margins from Tesla and them going to cash flow positive, causing a massive short squeeze on all the Tesla short investors. However, those margins, which peaked out at 30% in Q1 22, have almost been cut in half now, looking at 17%. Still a bit above industry average. However, there has been a bit of a reversion to the mean towards what the other automakers see in their margins as well. And there's a live look at the 30-second chart of Tesla after hours. We closed the regular session just below 208. Here we are just above 202. Only down a modest 2.6%, no big deal. But we did give away that support zone, of which 205 was the bottom. And so the next one we'll be looking at is this 194.40, where we made a low in late October. We'll see if we can hold that tomorrow. However, so far this year, Tesla stock is now down about 19%. So definitely the weakest performer out of the Magnificent Seven, all of which are positive for this year so far. And moving on to China, my regular viewers know I've been talking about the deep value in China for a while. And after I did a bit of a deep dive yesterday, I did get a little bit of hate mail, which is okay. It's the internet. Everyone's allowed to have their own opinion. However, let me just make it clear. I'm not a communist. I'm a capitalist down to my bones. My long China trade isn't an expression of my personal politics or belief in support of the Chinese government. I couldn't really care less about them. It's just a trade at the end of the day. And I'm just looking at the numbers of valuation and the technicals. I just think it's a good risk reward setup. Not saying I'm definitely right. I just think it's a good risk reward. And like I said, at the end of the day, it's just a trade. However, I understand it is a little sensitive subject. A lot of people hate Chinese stocks, and that's okay. However, just looking at some news today, we're getting more big stimulus measures coming out of Beijing as they're really trying to get underneath their economy and markets. And that's what I think is also helping the trade, is we can lean against this big stimulus, because the lower we go, the more stimulus we should get. And I just think it's an asymmetric bet with a lot more upside. And so today they lowered their bank reserve requirements, which is equivalent of injecting 140 billion liquidity into its economy. And don't get me wrong, they still have a lot of risks. Deflations, real estate, not to mention the political environment of them clamping down on big companies the last couple of years. Still a long ways to go, even before they can come back to a reasonably priced valuation. And let me be clear, I don't ever think they'll match the valuations of US stocks. US stocks definitely deserve a premium. It's just how much of a premium. We've got the US stock market, 10-year PE at 33. China's at 13. I just think that gap will close a little bit. However, US should always hold a premium valuation over the Chinese stock market, and that's because the US prioritizes innovation over regulation. Whereas with China, it's the other way around. They prioritize regulation over innovation, and that's because it's a communist authoritarian government. Holding, retaining absolute control is their number one mandate, and that's what's affected their capital markets. Over the last 15 years, even though their economy's exploded higher, their stock market's actually gone lower. However, I'm speculating that could be about to change somewhat, and we might see a bit of a narrowing in the gap of Chinese stock equity valuations versus the rest of the developed world. We've also got big technical signs that I showed yesterday, how the market could be bottoming. And we saw Chinese stocks surge again today. on the back of these more stimulus measures. Not only that, they're urging big brokerage houses to pull back on short selling and wanting domestic investors to stop buying foreign securities, as their domestic markets have suffered massive outflows. There's a lot of Chinese investors have been jumping into US stocks as well, so they're trying to keep some of their money in their own backyard, and the Chinese government is pretty good at getting their way because they do have a really tight grip on just about everything going on over there. And don't get me wrong, I do understand the skepticism. It's obviously not going to be a walk in the garden getting out of this mess. They still have a lot of stuff to work through. However, when it comes to the stock market, if you wait for everything to be perfect, then it's probably too late because the market's always looking ahead and typically bottoms before we see all the good stuff unfold in the economy. There's a look at the daily chart of the Chinese large cap ETF FXI, ripping up almost 3% today, along with the Chinese internet ETF KWEB. Got Alibaba trading above $75 a share now, and a really nice big fat green candle on the China 50 index, getting back above its 50-day VWAP for the first time since early September. A lot of volume down here. There's a good chance we could have seen a bottom, at least in the short term. We may come down and retest. And the best performing Chinese ETF today was actually one of my top 10 picks for this year. That's the China Small Cap ETF under the ticker ECNS, up a bit over 3% today. And like I said on my video yesterday, I think we're really oversold here, getting my bullish reversal signals, which is pretty rare for a country index, and has a pretty good hit rate looking back in history, and just a massive divergence from the rest of the world's equity markets. And like I said, I think the CCP is recognizing this. They don't want to continue this national embarrassment, and they see if it keeps diving, that could potentially cause some social unrest and continuing fleeing of capital, which affects their economy, jobs, and everything else. So I think we're going to keep seeing more stimulus measures coming out of Beijing to try and bring back capital, maybe get a little bit more business friendly while still holding tight control over everything. And like I said, I'm not looking for China to go on some massive 10-year bull run overtaking the States. I just think even a modest mean reversion of 50% could make for a really good risk reward here. I think there's more upside than downside. And like I said, guys, at the end of the day, it's just a trade. I don't care what country or stock it is. It could be called Blue Monkey Dishwasher. I'm just looking at the fundamentals and technicals and trying to make some money on. Okay, moving on from China, and wouldn't you know it, Nvidia and a few other tech companies have announced a new partnership with the US government to do some AI research. And that's the US National Science Foundation launching the National Artificial Intelligence Research Resource Pilot program with significant support from Nvidia. Didn't really hear a lot about this in mainstream media. And it's a pretty broad program as they're bringing together a coalition of government partners, including Department of Agriculture, Department of Energy, Veteran Affairs, the Space Administration, health, so on and so forth. And what you definitely won't see in the mainstream media is how Nancy Pelosi and her husband bought a load of call options on Nvidia just a bit over a month ago, with some calculations showing they're up almost $1 million. I guess she got lucky just getting in right before this big government program came out, partnering with Nvidia, sending the stock ripping to all-time highs today, now up over 35% in just a little over a month. Nancy reported her purchase of Nvidia call options right before Christmas. And so I guess she just keeps getting lucky, or is it like the original Wolf of Wall Street, Jordan Belfort says, Nancy Pelosi just may be trading on insider information. That was speaking to Tucker Carlson on Twitter, saying that she must be trading using non-public information instead of being a stock-picking genius. According to Belfort, this fact makes the representative a criminal. Still, he stated that he believes that in the current climate, people in power, especially the members of the Democratic Party, are allowed to operate with impunity, and that the media is largely silent on the issue. And I don't want to get into politics and take the side of the left or right. Personally, I'm more of a centrist. I've voted for both sides of the political spectrum over my life. However, I did see someone on Twitter say today, can you imagine if Trump made this same trade whilst he was in office? I think we'd be hearing a bit more about it from mainstream media, and I think we can all agree on that. However, you won't hear mainstream media or the big financial outlets report on this trade. Instead, you're more likely to see headlines like your grandma is a downside risk to the stock market. A sad state of affairs indeed. And anyone out there who's still innocent enough to think it's a fair level playing field, I'm sorry to burst your bubble, it's just not. Looking at market breadth today, got a pretty healthy 594 stocks and ETFs, breaking out to 52-week highs, led by the semiconductors and mostly tech names, and a pretty low 54 securities hitting 52-week lows today. Believe it or not, BlackBerry is still around with a market cap of 1.7 billion, and look at those yearly performances and all the stocks breaking down. They've already been weak for a while, so the weak getting weaker, strong getting stronger. A little bit of a counter move in the VIX today. Normally when we see the stock market up, we see the VIX down, actually bumped up almost 5% today, still very low here, just above 13. And with Treasury yields holding firm, we've got a bit of a pullback again today in TLT. Like I said yesterday, I'll be looking for a bit of retracement of that move up off the October lows back into the Fibonacci golden pocket, which will coincide with my lower buy-sell band indicator. Around $90 a unit, we'll be looking for some support on TLT there. Still got high-yield bonds trading a lot better than treasuries, managed to hold above their 50-day, and the dollar just kind of holding ground above 103, with continued softness in Bitcoin, still trading below 40,000 a coin. And look at that, and shipping rates popping up again today to multi-month highs. What's happening in the Red Sea is keeping the cost of shipping cargo, insurance rates, all of that high, which is an inflationary pressure. Gold looking a little soft here, continuing to peel back from its all-time highs, and quite a big bump up in natty gas today. It's been very volatile with the weather in the northern hemisphere. Apart from China, all international stock indices were a little soft for this mid-week session. And there's the growth first defensive sector chart of ETFs, breaking out again, getting near highs, and growth first value breaking out as well. There's a look at the BlackRock Bitcoin Trust ETF, giving a little bit of a bounce here today, with the weakest sector being clean energy, still very volatile. And once again, the strongest sector, semiconductors, with a bit of a bounce up in energy stocks, and financials actually breaking out, holding really strong, along with industrials still above the 50-day. But we're seeing a continued rotation into growth out of defensive names. We can see that in utilities again today. Big bearish engulfing candle here. Consumer staples just losing their 50, but the best performing defensive sector, healthcare, still holding up there. My 2024 picks as a whole were up today. That's thanks to the cannabis ETF, finding new multi-month highs again. There's Apple holding ground, Microsoft breaking out to new all-time highs, and Meta back to all-time highs and coming back into the $1 trillion market cap club today as well. Huge bump up in Netflix, even though EPS a little lower than expected. They blew past expectations with 13 million new subscribers added. Market really loved that, held its ground there today. Meme stocks were weak across the board. There's that spread of the Bitcoin ETF versus Coinbase, still holding ground. Bit of a pullback in Spirit Airlines today, and some pretty nice moves up in these vulnerable regional banks. We had Zion's report, they're holding ground, and same with First Horizon, actually trading up here today. And the big guys as well, just showing the finance sector is really holding its ground here. We can see that with JP Morgan, although we do have this big bearish candle here after the earnings gap up on a bit of a bearish divergence. So we'll see whether we can break through that and flip that bearish signal to bullish. All right, guys, there we have it. Getting above 4,900 on the S&P 500 today for the first time ever. Tomorrow could be interesting. We've got GDP data coming along with weekly jobless claims. Then we've got PCE data on Friday. So a bit of economic news could get things moving. Already got those treasury yields moving up, oil moving up, and that's probably why we've got a bit of a move up in the VIX one day. But still volatility risk premium. That's the implied volatilities option dealers are asking over realized. Still pretty muted here at 3.6. So option dealers are not really forecasting any fireworks right here. But once again, it's just mega cap tech, especially semiconductors, with Nvidia now at 1.5 trillion market cap, really just doing the heavy lifting of this market. Even though we've got a weak Tesla, this thing is just a steam train and powering ahead. And I'd say part of this big move was the market getting wind of that partnership with the US government and just more and more positive signs for the stock. If only we all were privy to that sort of information, it would be a lot easier for us. However, that's the way it is, and we'll wrap it up there. Thanks very much for tuning in to Click Capital. Appreciate you guys' support and getting this channel to over 5,000 subscribers. Thanks very much. My name's Jared. Hope I didn't offend too many people today, and I'll see you again tomorrow night. Cheers.